There's certain situations where I do not recommend taking any equity risk, and usually these are situations where money is already earmarked, and particularly when money is earmarked for a relatively soon to be made purchase. So, say within the next 5 years, you could think of like down payment for a house or something like that. There's a couple things you could do. Typically, I would advocate for investing that money in some sort of fixed income bond investment. But in particular, you might look at something called bullet funds. Bullet funds are fixed maturity bond funds. Standard bond funds uh, accumulate investor cash, and then they purchase bonds on the market, but they're always replacing any of their ETFs. This works a little bit different, but anyway, they're always accumulating bonds and getting rid of bonds that are maturing. So there's this constant rotation of bonds on their balance sheet, which means that a standard fixed income bond fund is never going to reach a maturity date. It's always sort of always has a some extended duration. There's always a point in the future where more bonds are going to be coming on. Okay, when interest rates change, the prices of bonds change, and the reason this is because the mathematical equation we use to value bonds has an interest rate assumption in its denominator. So since it's in the denominator, when interest rates increase, the value of existing bonds decrease. And when interest rates decrease, again, since it's in the denominator, if you're dividing by a smaller number, that means the answer is larger. So prices of those bonds go up. If you hold a bond to maturity, though, none of that matters. And the reason is because the company is legally obligated to pay back the principal. It's usually $1,000 increments or $1 million increments. It's a flat increment, regardless of what the market is going for. Which means that if you're investing your money for something that you want to be reasonably assured you'll get the money back, but you will earn interest on it in the meantime, and you don't want to be worried about interest rate fluctuations, market fluctuations, a fixed maturity bond fund could be really helpful because there's a legal obligation for you to get your principal back, but you're getting an interest rate in the meantime.